Hello, my name is Eddie Toffpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. The main activity here since December last year is twofold. However, before looking at those, there is a pattern in operation that I've highlighted since last summer, and one that still needs to be highlighted. You see, some while ago I had pointed out the cat's ears pattern over June and July 2023. In essence, this is a double top formed in an overall downward moving market. The potential for, below for such a cat's ears pattern is target X2 in the 502 zone. Now, for a while during autumn, it looked like we would never get there, but since late November and especially December last year, the market gradually started to approach this potential pattern target. In March this year, we had the closest so far approach towards target X2 down to the 38.2% absolute Fibonacci line at 521. And this is where the idea might have come unstuck, as this 38.2% absolute Fibonacci saw a rejection in March and a climb up and away. Prices have pushed up over the bright red highlighted March 2022 to date downtrend, currently at 533, and most recently over the bright green highlighted upper tine, and that's currently at 570 of the broken and maybe repaired late December 2023 to late January 2024 bearish shift pitch hook, plus also the short medium moving average currently at 577, which had reinforced the upper tine since February. For the moment, I will still keep the bright red downtrend and bright green bearish pitch fork on my daily chart for one simple reason. They had, especially the downtrend, been excellent at showing the recent bearish angle of attack. So what can we say about this very recent rise? Well, it is from a potential V bottom, but is just about to run into some significant resistance from the flatlining medium moving average overhead, currently at 592. At the March low also at 592. However, better resistance is further up at the combination of the July 2021 high at 609 and the declining long moving average, currently 614. Now, between these two areas, we saw considerable congestion between September to November last year and again mid-January to mid-February this year. Now, that is a point to note. Chicago corn. The medium moving average, currently at 473, highlighted in mauve on my daily chart, had been an effective cap on this market throughout 2023, most recently October, November, and then December 2023. When it was penetrated in December of last year, it still held down the market. Additional to the declining medium moving average, we also have the same old congestion band overhead between 490 and 498, including the 2021 low at 498, plus, we did have the short medium moving average. That's down at 442. And that's still highlighted in green on my daily chart, which had untangled itself from the medium moving average in December last year and started to reinforce the February 2023 today downtrend. That's currently at 436, and that's highlighted in dark blue on my daily chart. Now, I'll return to these and the disparities shortly. Going back to mid-February, the prices had punched down then, reaching the primary target 424 for the July 2023 to January 2024 descending triangle, highlighted in bright red on my daily chart. In the process, the market also punched down through the important 50% absolute Fibonacci line at 425. However, this piercing move low was too much for the market to swallow, even though it also breached, although did not break the next support below, which is the December 2020 low of 414. It's from there that we saw a strong recovery, creating a nascent bull channel from late February to late March, which last week the market broke down through on the downside and found a combination of support to seemingly base itself on at the November 2020 high of 439, plus the green highlighted short medium moving average and the broken blue downtrend. I told you they would feature again. 3 weeks ago I spoke on this rise and said at the time, and I quote, "So it is a significant attempt higher. As to whether it will succeed, well, that is a close run thing at the moment. But I would observe that we have not accumulated that much ammunition below, so it will be interesting to watch," end of quote. Now, I am still minded to think that despite the attempted V bottom in late February and the subsequent failed small bull channel, it still looks like the ammunition below is not enough. Not yet, at least. All I can really add is just be mindful of target X1 below at 374. This is the secondary and much harder to reach target for the descending triangle pattern. Kansas City wheat. Slightly less going on here today than it was 3 weeks ago. However, there's still a lot here within a fairly narrow piece of action. Not in market price, but in a narrow piece of angle of attack action. To explain once more, 20 weeks ago I highlighted a feature I saw then whilst I was looking at the action since August 2023. It was a descending expanding wedge pattern, currently 554 to down off the bottom of my daily chart. And it's highlighted in dark blue on my daily chart. Now, this is not the best example of such a pattern, but as I said 18 weeks ago, and I quote, "It does hold merit, and I would look to this pattern for some immediate idea of the move downwards," end of quote. Well, it did until recently showed a way lower. But it wasn't an easy decline, having been pierced on a number of occasions and now seeing the market running along on the back and on the top of the upper trend line. During its lifetime, I've also seen the development of two new patterns, two ones, one of which involves the descending expanding wedge pattern itself. So back in early December last year, we had an attempted move higher, but it ran into the combination of the upper trend line of the descending wedge pattern and the green highlighted declining short medium moving average, currently 589. Indeed, for a while, this pair of dynamic resistances held prices down. However, at the start of 2024, they started to separate, and in late January this year, we saw the market head lower. Initially, I thought it might be a descending scallop pattern, but the market was and is too stretched out to be a descending scallop pattern. And so instead, we still have, I suppose, a descending triangle idea from late November 2023 to mid-February 2024. That's highlighted in purple on my daily chart, with the trend lines for both having crossed over early last week. 7 weeks ago, we had an attempted breakout below this descending triangle, but prices hesitated and have continued to hesitate, such that what I initially thought might be a triple or quad bottom is now a quintuple bottom and looking more like a rectangle pattern in shape. I'm still not sold on what shape it is becoming, however I can still lay out some ideas below for a break lower from the descending triangle. Thus, a primary target X would be in the 539 zone, with a secondary harder to reach target X1 down in the 487 zone. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Topic and ADM Investor Service International Limited. And here comes the final important bit.